Welcome to Silicon Valley Successes. On today's show, we have Jeff Faust. He is the Director of Valuation Services at his company, ASL. Jeff is part of the Emergent Business and Technology Group. He has 20 years of experience in the valuation of privately held companies to determine stock option grants, stock option plans, estate gifts, mergers and acquisitions, and more. And you're about to meet him in a moment. Jeff, welcome to Silicon Valley Successes.
Thank you for having me.
Now, how does one value a company?
Well, it's a great question. We really look at three areas to value business. The first one is revenue. Is the company generating a significant amount of revenue or having a lot of relationships with businesses? Second would be cash flow. Does it make money for the business owner? And third would be assets. Does it have a significant level of assets, whether that be tangible assets like equipment or intangible assets like goodwill, customer lists, or workforces?
Now, for a startup though, they might not have all those. Is it a different set of things that you look at to value a startup?
Very much so. So we look at the potential for a lot of startups. So what's their market size? How much can they penetrate in that market? How large can they get in a quick amount of time? Their ability to scale, and a lot of other external factors because you don't have the financial metrics inside the company yet.
And when a company comes to you for a valuation, does it kind of matter why they come to you for that valuation?
Absolutely, yeah. That's one of the misconceptions when you talk about valuation, that there's kind of one number. And really it's the purpose of the valuation that drives a lot of the methods that you look at. For example, granting stock options to team members, you typically want a lower valuation than you would if you're raising money for investors.
Well, why would you want a lower valuation if you're granting stock options to employees?
Because you want to reward the team members who are typically working for less salary. They're getting some options and equity in the business in lieu of some comp. So you want to give them a reasonable share price to give them a reasonable return. The primary reason for that, though, is the standard of value changes. When you grant options, it's fair market value is the standard. When you raise money, it's called investment value. It's just a different focus. Probably the best way to describe that is fair market value measures what you have now. So in a typical business, brick and mortar business, they might have equipment and income and revenue and cash flow. Startups, they don't have a lot of that yet. So it's the potential that you're really looking at. So again, in a startup, if you're measuring fair market value to grant options, they don't have much, so you can get a really low price, which helps us, an option recipient.
So I could come to you and you could give a valuation for my company, and it could be a range, like a high-low, or is it always just kind of one number and you base that on what I currently have? Or what is it?
It could be a range of value, but a lot of times we have to establish a price per share to grant stock options to an employee. So we will establish a number. But we're focusing on different things to grant stock options. For example, again, we're looking at what they have right now, which isn't much. Whereas if you're raising money, you're looking at the potential, which is going to increase your valuation because you have a lot of potential as a startup. A different standard of value, so it's a different focus on the models. And you're using different models in that circumstance as well.
And does that matter what sector the startup is in, or startups are startups?
Startups are startups in that they don't have a lot of financial metrics, but their potential is very industry specific. And one of the things we'll talk about at some point is peer group. What are companies like yours in the startup space? What is their valuation? Are they in a 1x revenue business? Or are they in a 10x revenue business? So you see a lot of variances. So it really does matter on an industry based on your potential. There's some industries that are growing a lot more rapidly than others. So that definitely matters.
So talking about an industry that's growing really rapidly, could it also be kind of an industry that's, I guess I'd say, flavor of the month? So for example, maybe a year ago, a blockchain company might have a higher valuation than an AR/VR company, but maybe 2 years ago, 3 years ago, that AR company might have had a better valuation. Would that be a fair assessment?
Absolutely. And investors' appetite for that specific industry sort of means they're excited to make an investment in there, which could potentially lead to higher valuations in that space. So industry is very specific. There's a thing, if you type Google hype curve, go to do a search on hype curve, they'll show you the technologies that are sort of in flavor now and ones that are kind of falling out of flavor. So that's a really good information for an entrepreneur to know, is what type of industry are they in on the hype curve? Are they in that business that's sort of getting that hype, which could potentially lead to higher valuations and greater potential? So it's really important to know that as well. So yeah, it is industry specific. So
does a startup always want to get the highest valuation possible for their company at that moment?
That's a great question. You have to plan on a couple rounds. So have been companies who have too high of a valuation early, and they don't make enough progress with the money they raise on that first round, so they can't justify a valuation that's higher than the first one, and you create a circumstance where you have what's called a down round, where your valuation in your next round is lower than your prior round, and you don't want that circumstance. It's really tough to raise money when you're doing a down round, so there is something to be said about having too high of a valuation early. Theoretically, it's a good thing, because if my valuation is really high and I need to raise $1 million, I'm giving up less of the company for that million. But again, you could end up with a circumstance where your valuation is just way too high early on. A company that doesn't have much, you shouldn't be worth $20 million early on in the company. So you can't have a valuation that's too high.
So for a company between rounds of funding, valuation from, say, their A round to their B round, what's determined for those milestones or things that need to be hit for them to increase that needed valuation for that next round?
Well, there's a formula that is used in valuation, income divided by risk. It's one of the oldest methods that exists. It's the capitalization of earnings method. But that method itself drives value. I mean, how you increase value in general is either you increase your ability to generate income or you decrease your risk. In startups that don't have income, they only have one, and that's risk. So they have to demonstrate that risk is falling from round to round in order to justify an increasing value. If you don't have the financial metrics as to drive your valuation, you have to have that risk profile. So that income divided by risk is sort of something for an entrepreneur to keep in their mind, because if they don't have the income, they need to hedge risk somehow to justify increasing values.
And then how is that information presented to an investor?
That's a good question. I mean, valuation is not an exact science, and so it's kind of a negotiation. So a lot of times we will advise, once we work with the company on determining their valuation for funding purposes, we will work with them on how to present it. So you kind of want to present the key drivers. What is your peer group? Are you in a 1x revenue business or a 10x revenue business? So you want to present the drivers. You present your projections, you present kind of your stage. Where am I at? Am I a concept company? Do I have a product yet? Am I alpha, beta? Am I generating early revenue? So you have to be very, very clear in your stages for that.
What type of information does a startup need to present to you for you to assess where they're at?
A lot of it is an understanding of where they're at. What is their stage? Again, are they concept mode? Are they in alpha, beta? Are they generating revenue? Are they getting close to being cash flow positive? So financial information is first and foremost. I need to know where they're at stage-wise, and the financials typically will tell me where they're at on a stage-wise. Second would be their potential. Where do they expect to grow, and what's their growth rates, and what kind of market penetration are they going to have? And then third would be, we need to understand the industry they're playing in so that we can properly assess the peer groups. And when I mentioned peer group, I mentioned that word earlier. It's publicly traded businesses that are in their relative space. And the reason you need publicly traded businesses is because you know what their valuations are. You know what their revenue multiple or their earnings multiples are. It's either 5x revenue or 2x revenue, whatever that is. So you need to kind of know what industry you're in. So having an understanding of their peers is important. One of the things we can help companies is helping them find their peers. That's one of the things that we do for a lot of companies. Some startups, they might have some financial metrics and projections built, but they don't know who their peer is. And that's something we will help them kind of build their peer. But that's critical in determining the funding valuation.
If the company is a very disruptive company, they're years ahead of anyone else, say, Uber or Lyft, right, and there's not that rideshare public company yet,
then what do you compare it to?
That's a great question. You have to build a peer. Internet of Things was something that came out, and same with these rideshare programs were something that came out as well, where there really wasn't Internet of Things yet. Now there is some publicly traded IoT companies, but you have to build peers that build a component of that business model. For example, Internet of Things requires software. It's also hardware dependent. It's systems based. It's a CRM. It's cloud based. And so you can grab companies that are in cloud. You can grab companies that are in SaaS, in CRM, in hardware, and you build kind of a list of companies that might hit all of the aspects of your model, and that builds yourself a peer group that way. So these ride shares would probably be using some older limousine companies, taxis, but maybe using some software companies. People who connect people together. So you'll have to use some software providers or some social media, because there is some social context to that. So you'd have to just build and be creative with building your peer through other similar businesses, because you just don't have the comparisons yet.
So when building these peers, how much of it would you say is a science? How much of it would you say is an art?
Equal amount. There's no two companies alike, so doing any sort of market comparisons is always a challenge. You're just not going to find businesses the same. So you always have to stretch a little bit, and sometimes we use it's statistical in nature. So there's a concept of a law of large numbers, which means you want more deals that are sort of similar than one or two that are perfect. And so you just have to be willing to accept the fact that you're not going to have the perfect company. Most of the smaller startups aren't going to be competing with huge public companies anyway, right off the bat, but you have to be willing to accept that these might not be truly comparable, nor are these might not necessarily be considered my competitors, in order to accept kind of that peer multiple.
Now, are there certain areas that you might not even be able to compare to? So, for example, a startup maybe from Ukraine or Russia or another country competing against a Silicon Valley startup. How would you compare that?
That's a great question. And often those companies, because there isn't the peer groups and there isn't a lot of broad knowledge about their industry, they have to get further along and actually have financial metrics in order to get investment money. So when you're lacking that, the investor is not going to feel comfortable with it. You have to have those financial metrics. So most of the time when we see foreign companies come into the Valley, they're actually cash flowing. They're profitable, they're break even, and they're looking for money to scale their idea most of the time, because they don't have the metrics and they're coming from a foreign country, so they're already at a disadvantage because the investors have to get comfort with them. And so that for them is really the financial metrics will be their starting point rather than the peer group.
Wow, this is amazing information. And to find out more, visit SiliconValleySuccesses.com. Sign up for our Facebook group, check us out on LinkedIn, where we provide information daily, updating you on some amazing things that are happening here in Silicon Valley and some amazing things that can help you become the next success. Now, Jeff, the team. When I go to these pitch events, I hear investors go, and the most important thing is team, 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 and team. How do you value a team?
That's a great question. You can't really put a number on team, but when we talked about risk, income divided by risk, that formula, team hedges risk. And these days, investors want risk hedged, because that means greater valuation, greater chance for this entrepreneur and this company to be successful. So that's why investors won't fund concepts now. Your company has to be further along. You have to have a product. A lot of times you have to have traction now. And so you have to have a strong team. So the milestone keeps getting pulled further and further down, because investors want their risk hedged more and more these days. So it really is a function of risk. When you have a really strong team to execute, they've made their mistakes, they won't make those again, they've had success stories, you're really hedging your risk as an investor, which does lead to increasing values and a lot higher likelihood of success. So it really goes to that risk factor.
So what are the benefits of me going to a professional like yourself to get a valuation versus me looking at a napkin and going, this is what I want?
Quality, and you can call me with advice. There are software tools that provide valuation services, but I'll tell you there'll be all kinds of gray areas an entrepreneur comes up with. Or an investor will come with a counteroffer on investment. You can't call a software tool or ask advice from a napkin. You can call me and ask me for advice. Here's their range. We can kind of work together. A company will have a valuation need very, very frequently in their life cycle. I mean, a startup who has several rounds of financing, they're going to need at least once a year evaluation for granting options. You're going to raise a couple rounds, so you're going to need one there. So it's going to come up enough where you're going to have someone that you want to talk to. Otherwise, you could be leaving a lot of money on the table, which means, again, you're giving up value because you're not pricing yourself accurately. Or worse, you're so far out of range that you're not getting the meetings or traction with the investors. So really quality and making sure you're in the right ballpark is really important.
So there's a term that I've heard, 409A valuation.
Right.
What is that? And why would one need to know about it?
So 409A is a code section that says you can no longer grant stock options at a discount. For a long time, you could grant stock options at a discount, non-qualified stock options. So if your stock was worth $1, you could grant it at 85 cents. With the advent of 409A, they basically said you can no longer grant stock options at a discount. Part of that said, well, if I can't do a discount, how do I know I'm not providing a discount? It sort of created valuation rules around that. So these was put in place to allow formal valuations to be done, and now it requires startups to do formal valuations, and that's to establish the stock option grant price. That's what that's for.
Now, having a 409A valuation, do investors want that? Do they not want that? Does it affect them at all?
They do want that because remember, it's about hedging risk. If you don't have a 409A valuation, there's a risk. It's an IRS rule. If you don't have one or you didn't get one and you granted stock options, you are taking a risk. And there's an exposure to that 409A code section. A lot of investors don't like that company having risk. And so we've seen acquisitions and even investments blow up because the company did not do a 409A valuation early on in their life cycle. It is incorrect. It says you're too early to do a valuation. 409A says every time you grant stock option, you have to have a valuation. Now the cool part is companies can do it themselves, but if they do it themselves, they have to follow traditional valuation models, which most people don't have the skills to do that, and they hire third parties like us. Very important to adhere to 409A because you're hedging risk, and you have to do it.
So these companies that go to incubators and the accelerator programs, and they're all given the exact same valuation or a safe note or something that says, we'll give you $100,000 for 7% of your company. Today's valuation is this. What's your opinion of that for these companies? Is it hurting them, helping them? Does it matter?
I don't like it, primarily because through peer group research, we find too much variance in companies in early stages and their potentials that if you're in a really high multiple business, you're leaving money on the table. Now, if you're in an old school brick and mortar type business or a traditional software, so you're just kind of that tech company where maybe you have a low multiple, a 1 or 2x, maybe. But if you're in big data or data analytics where you have a much higher multiple, I think you're leaving money on the table. So I'm not a big fan of that.
And then if a company doesn't like their current valuation, what are the best ways to change it?
Well, fortunately, funding, there's no formal valuation requirement for funding. So it's a negotiation. So if you don't like the valuation that you have, you can try to ask for more if you go to an investor. The challenge is the reason the range exists is probably because there's some metrics that justify that range. And so trying to push out of that range to raise money would be very difficult. Or might be difficult, but might be challenging to raise money. For 409A, you really can't do that. I mean, that's why you need to make sure that the person you hire is certified and qualified to do that. Because if it's wrong, you're kind of stuck with it. And the IRS may challenge it someday, and so you're kind of stuck with that.
When you said that companies that haven't done 409As, you've seen deals just blow up.
Yeah.
What does that look like? Is it just we can't do it because of this? Now we have to go back and redo some paperwork, or it's literally this can't happen?
It's them wanting to see it fixed, and so by acquiring this company that has a 409A violation or they did not do one means that they're absorbing a risk, and so a lot of times they'll say, go fix that. And so to go fix it would be to go back and do historical valuations. If they used a price that was probably too low, you're going to have to go fix all the grants, so cancel all those agreements, issue new grant agreements. There's all accounting charges, because if you've been expensing your options, it's a very time-consuming and expensive process. It could be $20,000 to $50,000 to correct wrong 409A price. Could be 6 months to a year to do that. Most acquirers won't wait around. I mean, they're moving fast. They could buy your competitor down the street. They won't wait around for you to fix it. They'll just go buy someone else. So that's where we've seen a company not willing to wait for a company to fix a 409A. They just go find another solution to buy. So that's where that can blow up.
Earlier we had mentioned that startups might not have all the financials for evaluation, but they could be judged a lot in potential. What about later stage companies? We'll say Series B. They have 1 or 2 years of financials. What are you looking for there in their evaluation? What information do they come to you with?
So they should have, like you just pointed out, a good track record of financial performance. There should be some financials. They may not be profitable yet, but they should be generating some revenue. The revenue they've been generating, the business plan that has gotten them to that spot, they should be leveraging to build a very comprehensive business plan. It's still going to be on potential, but the projections that you do are going to be a lot more, I don't want to necessarily say accurate, they're a lot more credible. When you don't really know your revenue model built and yet you're putting projections in front of an investor, it's a little bit challenging because you don't even know what your revenue model is and now you're forecasting revenue. But when you actually have some traction, it's a lot different. And so having a very comprehensive projection model and understanding of where they're going is critical. And most of them also, because they've been through some financing, they've probably had a chance to have conversation with investors about those peer groups or comparables. We want to know a pretty good list of who do they consider are their competitors or their peer group, and also who's raised money that's like them. That's another thing that we can help companies with is private placement research. But a lot of them know here's 3 or 4 companies that are doing things like us, and here's what they've raised. So a good understanding of what's going on in the fundraising market is also important.
So then who comes to you normally? Is it the startup? Is it a VC that says, I have a startup I'd like you to look at? Is it an angel group? Or is it an investment banker? Who says we need this?
It depends. We get approached by all those groups. Mostly it's an entrepreneur. Most of the time, there are ventures who feel confident in their ability to set valuations and assess deals, but there are VCs and investors who do ask for us to look over their shoulder and help them price deals, just to be that second opinion. Most of the time it is an entrepreneur. We had a company actually who they were looking for their Series B. They had a bunch of investors that were interested, but the investors were not sophisticated enough to set their own valuations. They were looking for a lead. They actually hired us to do a comprehensive funding valuation, and because we were certified and we helped them present the valuation to the investors, we sort of helped them lead their own round. That's part of your question about why go to someone like us is, the quality's high, and we're able to then take the data they were using and the investors they were negotiating with and kind of present a package and help them lead their own round. So really a good understanding of kind of what's going on in their space is important. We can help them kind of package that up to present to investors.
And do you ever get in the middle of maybe a discussion between 2 co-founders when they're talking about dividing up equity or splitting the company up or shares for the employees and that? Are you ever involved in those kind of conversations?
Yeah, we do get asked because we see a lot of grant ranges and companies issuing stock option grants. We get asked, what do you see of these ranges? What is a typical range for a CEO? Or I'm hiring a group of advisors. So we do get asked a lot of advice on those ranges. And we see some patterns with certain option ranges and percentages.
And what advice would you give an entrepreneur out there when they're setting up their company, when they're at the very early stages?
I think they should go as far as they can without raising money. One of the biggest mistakes I see is companies either get to the valley or they get excited about the valley and want to start looking for money and talking and having these pitch sessions. People just get wrapped up in the kind of the valley and pitching. And most often there's investors that just won't give money to a company at that particular stage. So get the company as far as they can without raising money. Having a third-party investor creates all kinds of challenges. You have to answer that investor. There's milestones you have to meet. And so it's just easier to get further along. You're going to have a much higher valuation when you raise the money too. And so it's just easier to take it as far as you can before you even start looking for money. Just focus on the product and a customer solution rather than raising money early on. That's the best focus.
Wow. So to go over some of the things we've talked about how avoid taking money as long as you can. We've talked about overseas companies, when they come here, they may already have cash flow positive. So when they go to evaluation, sometimes what they're being looked at is a little bit different because they might have these financials. A later stage company will have the financials that an early startup doesn't have, but that early stage company might be judged more on their potential. We've talked about accelerator programs and how that boxed valuation may not be the best for some companies because some companies might be leaving some money on the table. Talked about coming to a valuation expert because there's someone you can call versus a napkin who can't give an opinion if you're in that negotiation with investors. We've talked about many things here. what are we missing? What information still needs to be delivered to that founder to really help them out, that entrepreneur?
Well, one of the things I thought would be helpful to really touch on quickly is terminology.
We have time.
One of the things I think that comes up a lot is when an investor asks about valuation, an entrepreneur thinks something different than an investor. There's something called pre and post money. So when a company is looking for money, there's the value before they get money and the valuation after. So here's an example. A company is looking for $1 million to put in the product. They are a $4 million company before they look for money. So the way the math works is that the pre-money plus the cash they raised gives the post-money. So they're a $4 million company prior to raising the million. They're $5 million after they raise that million. So that math works out where if an investor puts a million in, he gets 20% of the company. What happens is that's the scenario that plays out, but when the investor asks the entrepreneur, what's your valuation? They often say 4 million because they're thinking before money. So now the investor knows they're looking for $1 million, so he's thinking to himself, oh, $1 million, so I'm getting 25% of the company because he's thinking million, $4 million valuation because he's thinking post money. So most often they're disconnected. So the entrepreneur is thinking he's trying to give up 20% when he's really just offered the investor 25% of his company. So the entrepreneur needs to understand when an investor asks for his valuation, that's a post-money number. So again, it's their valuation they're determining plus the money they're looking for is the valuation he should be mentioning to an investor. So that's really important, that terminology.
So the entrepreneur, should they specifically say, I'm raising 5 million post-money, or should they say 4 million valuation pre-money and I'm raising 1 million? How should they explain this?
So a lot of times they'll use the money they're looking for over the valuation. So that would be a 1/5 circumstance. So if an entrepreneur says, or an investor asking what's your valuation, it's a 1/5. So I'm looking for $1 million and I'm a $5 million valuation. So that then the investor will know, okay, I'm going to get 20% for his $1 million investment.
And Jeff, what is the best way out for people out there to find out more about you and to get in contact with you?
So our website, aslcpa.com, is the best place for information. And of course, you can do searches on Google, and I'm on LinkedIn as well, Jeff Faust.
That's great. And everyone at home, thank you for watching Silicon Valley Successes. Today's guest, Jeff Faust, gave us some amazing information that I hope everyone at home can now implement in your startup, your business, and help you to become the next success. Thank you, and see you next week.
Thank you from all of us at Silicon Valley Successes. We hope you found the information presented today useful in your path to success. For further information on accessing the resources in Silicon Valley, you may visit us on the web at siliconvalleysuccesses.com, on Facebook and YouTube. Thank you. And remember, we want to help you in your journey to become the next success.